Knowledge isn't just the foundation of wealth, it's the secret weapon that separates the rich from everyone else. Financial success has rarely anything to do with luck. It's about mastering the terms and strategies the wealthy use to stay ahead. If you don't know how to play the game, you're not just at a disadvantage, you're doomed to lose while the informed keep getting richer. Knowledge is knowing the right terms and how to apply them, and if you don't understand these financial terms, you're setting yourself up to lose at the game of money and building wealth. Terms like compound interest, asset allocation, net worth, credit score, and diversification can make a world of difference in your financial journey. Ignore them and you could be missing out on opportunities or falling into debt traps. Learning them and you'll be ahead of the game, making smarter financial moves. So let's dig in and discuss my top 20 essential financial literacy terms. So the first term we're going to talk about, and it's actually two words that I always think get tied together, are assets and liabilities. And an asset, people think of it all different kinds of things, but it's actually just something of value that you own. It can be investments, it can be real estate. I don't think of things such as like cars or property, like motorhomes or boats necessarily as assets, even though if you own them free and clear, you could sell them for things like and get cash, which would be considered an asset. But I think of assets as a thing that over the long haul should become more valuable, and ideally, especially with real estate, you could own free and clear and you could earn some cash flow from it. Liabilities are basically just the debt owed on those things. So if you have a mortgage, that's a liability, or if you have a car loan or even a mortgage, things on those lines, credit card balances, those are liabilities, and some are good and some are bad. So we want to talk specifically about those in the future. The next term that people talk about, and I think it's a little bit confusing for people, is net worth. And net worth is really just the difference between the total of your assets and the total of your liabilities. But again, to me, net worth is kind of an overblown topic. So as an example, let's say I owned a home free and clear that I lived in that was worth $1 million. Great, I have a net worth of $1 million. Well, let's say I own 3 rental properties and those 3 rental properties were worth the same $1 million, but they were paying me $5,000 a month in rent. Which one would you rather have? And of course, the net worth is the same, but I'm earning money off one pile of net worth and I'm not earning off of another. So just know net worth isn't the be-all end-all number, but it is a nice number to sort of give you an idea of where you are financially. So the next term, of course, is budget. I talk about budgets all the time, and its real definition is just a financial plan that tracks your income and expenses and helps you manage your money effectively, allocated towards savings, investing, bill payment, and your financial goals. So you have to have a budget. The next term is liquidity, and liquidity is actually a really simple term. It's just how quickly can you turn an asset into cash. So obviously, cash is your most liquid asset, and things like real estate are going to be your least liquid asset because it's going to take time for you to get it on the market, sell it, have it go through a transaction, and actually turn that house or building or whatever it might be into actual cash. And of course, then there's levels of liquidity, things like stocks and ETFs and mutual funds. There's different levels on how soon you can sell those things and turn them into cash. Just know the more liquid it is, things like cash, versus the less liquid it is, things like real estate. So the next one is emergency fund or rainy day fund. You can call it whatever you want to. It's basically just a savings account set aside for unexpected expenses or financial emergencies. And really, 3 to 6 months, anywhere from there to 6 to 12 months of living expenses is good for most people. It just depends on how you feel about your income, your job, and how much you're willing to not have a bunch of cash laying around. Some people are more risk averse than others. So just know, you can call it a lot of different things, but it's something you need to have and be aware of. The next term is the word interest. And interest, of course, is just the cost of borrowing money, or it is the amount of money you earn on your savings account or earn on your investments. So you want to be on the positive side of interest, basically meaning you're earning more interest and you're paying out. So paying attention to your interest rates on both directions of where you have money going is just something you need to be fully aware of. And interest is kind of a term that can be used in a lot of different ways. So following up that is the word compound interest. And again, I always show compound interest is the 8th wonder of the world. It's basically just interest calculated on both your initial principal and your accumulated interest. So if you had an account, you put $100 in it, and now you earn interest, say 10%, you had $110 in it. The next time you're going to earn $11 versus $10 of interest. And again, if you keep adding to a 401k or a Roth IRA and you keep putting money in there and you keep having the actual interest keep staying in those accounts, over time you're going to have exponential growth, and you need to know how compound interest works and how the growth of money over time, as those numbers get bigger and bigger and bigger, you'd be shocked how much interest and compound interest you'll actually earn. So credit score or FICO score, and it's just a rating system. It goes anywhere between 300 and 850, and that number really is just your credit worthiness based on your borrowing and repayment history. You only need a good credit score if you're going to plan on borrowing money. Obviously, higher scores are going to give you access to more money and lower interest rates, and that FICO score is just what it's called. It's typically the score that's most widely used by mortgage lenders, car lenders, credit card companies. But just know, if you never need to borrow money, you don't really have to worry about what your credit score is. And just know when you hear the term FICO score, it's kind of the same universal term that your credit score would be. So the next term is inflation. Of course, this is the rate at which the general level of prices and goods or services are rising. So if you had a dollar today versus you had a dollar 5 years ago, that dollar 5 years ago was more valuable because the prices of things were lower. Inflation is something you're hearing a lot on the news lately because everything's gotten more expensive. And what it does, it just makes each dollar that you just hold on to less and less valuable as that same dollar buys less and less over time. So you got to make sure that you're investing your money so that you can offset that cost of inflation. And then another term we want to talk about is amortization. And so if you are someone who owns a home or has a mortgage, you really should go to Excel and pull up a loan amortization schedule. It's the process of how you pay off your debt over time through regular payments. And of course, at the beginning on a house, payment number one is mostly interest and not a lot of principal. But if you plan an amortization schedule and it shows you at the beginning, if you pay extra on your payments, you'll see how much more quickly, like on a 30-year loan, if you just made the payment every month, you'd have 360 payments. But if each and every month you paid a little bit extra, you'd see how quickly, one, the total amount of interest over those 30 years would be a lot less. And that 30 years can easily become 25 or 20 years by paying extra at the beginning. So just go to Excel, type in loan amortization schedule, and you can play with the numbers on there. It's actually very interesting to see how much money you can save by not paying that much extra each month, especially at the very first handful of years on a 30 or 15-year mortgage. So if you want to learn more about personal finance and money management, do me a favor. Click the link in the description below. It'll give you a list of our top 11 things that you need to do to get you started on your journey to building up your financial plan. All right, so these next 10 terms are more about investment terms. The first one are stocks, and stock is just a piece of ownership in a company. So you buy a specific company, you own that stock, and it makes you partially an owner in that company. It's really kind of a simple and easy thing. Bonds, basically bonds are debt secured by corporations or governments. So what those companies are doing is they're trying to raise funds, and you're basically giving them money by buying a bond, and they're agreeing to pay you an interest rate. So bonds for years, especially government bonds, were always really good tools because it was guaranteed to make whatever interest rate they were going to pay you. So it's a very safe and secure investment. And you'll see people when they have these pools of funds, let's say in your 401k or IRA, some of it will be in bonds, some of it will be in stocks, and some of it will be in mutual funds. And so that's a term we're going to talk about next, which are mutual funds. And what mutual funds are is just a conglomeration of a bunch of different assets that we're going to talk about in today's video here. But really what it does, it allows you to diversify with being able to only buy one thing. So the big difference between a mutual fund and ETFs, which are exchange traded funds, are ETFs trade more like a stock. You can buy and sell them during the trading day on the market, where a mutual fund can only be bought and sold once the market is closed. But technically, they're very similar. It's just a portfolio of funds, like I said, whether it's stocks, bonds, or a group of companies in there. They're just traded differently. And I think over the long haul, I was talking to my buddy Ken, who invests all my money for me. You're going to see most of the ETFs. I think mutual funds are going to be something you're going to see less and less of over time, but you can still do both, and they're relatively similar. They're just traded differently. So the next two terms we're going to pull together again, which is a 401k or an IRA. And basically, your traditional 401k or IRA is a tax-advantaged retirement account. It's usually sponsored through your company, and most companies will have some sort of matching program. So as much as you might hear people talking negatively about 401k, if you put in $1 and your company's going to give you $1, you got to maximize that out. So whatever that amount of money is going to be, you're going to earn 100% on. The biggest difference between a 401k or a traditional IRA versus a Roth IRA is when you earn $1 on a 401k, you can put the whole dollar in. On a Roth IRA, you earn $1, you're going to pay tax first, and then you put in whatever your income is after. Say you earn 70 cents and you've already paid your tax. The benefit is on the back end, on your Roth IRA, all the money you've earned over the lifetime of that IRA, you don't have to pay tax on, where the 401k, you're going to pay tax on the back end. So I think it makes sense for people if you're doing a little bit of both, especially if you're in a 401k plan where they're, matching you 3, 4, 5%, that's 100% on your money. So you want to be able to do both, and they're slightly different, but they really, in the long term, operate very similarly. The next term, which we mentioned a couple times already, is diversification or asset allocation. And it's just your investment strategy that spreads investments across various assets. Like we talked about, stocks, bonds, real estate. It really depends on your risk tolerance, your financial goals, what age you are. You can always be a little more risk averse when you're in your 20s and 30s than maybe if you're in your 50s or 60s. And the goal is for the long term, it's just to try to reduce risk and maximize your potential returns over the long haul. You can also do that with the next term, which is dollar cost averaging. And so let's say you're somebody who gets paid every 2 weeks. This strategy is every 2 weeks, let's say $100 out of your paycheck just goes into your portfolio. You You need to invest it, of course. And then what happens is if you're buying a mutual fund, as those funds sometimes go up, sometimes go down, you're just buying it every 2 weeks, regardless of if it went up or down. So over the long haul, you're dollar cost averaging and you're sort of limiting your overall return risk. So I like that strategy, something I've done over the years, especially when I had a more regular job when I was younger and I got paid every 2 weeks. So it's just a term you'll hear on occasion. And if it's something that you're getting paid regularly, you should be doing. So we have two more terms here at the end. We have capital gains, which is just the profits you earn from selling an asset such as stock or real estate. The cool part with real estate is if you are living in your primary residence and you're a single person, the first $250,000 worth of your gains are tax-free. And if you're a couple, the first $500,000 of your gains are tax-free. And as much as prices have gone up over the last 5 to 10 years, that number for some people, it won't even cover all your capital gains. But the cool part is a large chunk of whatever your gains are will be no tax charged on those. So just know it's just an increase or potentially a capital loss, which would just be a decrease in your assets. And then the last term is tax deductions. And those are just things where you want to legally figure out how to lower your tax burden, which means, deductions like mortgage interest, student loan interest, charitable donations. These are things, and of course you want to talk to your CPA, because I am not a CPA, about what things you need to make sure that you're monitoring and tracking so you can do the proper tax reduction so that you can, maximize your income, potentially get a tax return check coming back in the mail, and then you can use that money to then reinvest, start to do more things to build up your long-term wealth and financing. So there are tons more terms. These are kind of my top 20 basic starter terms. If you have questions about any of these, by all means, reach out. We're happy to answer any questions you may have, or reach out to your financial planner, your CPA. I'm sure they can answer some of these questions for you as well. If you're someone who wants to learn more about personal finance and money management, check out this video we did so that you can learn how to do this more like the people who are in the 1%.